Owning Alibaba is really turning into an abusive relationship now, guys. Alibaba's shares are down once again this week, in part because the government has continued to crack down on the technology industry, and it almost feels like it's just been days since they said that they overreached on the tech industry and that they were going to slow down or ease up on the regulation, or at least clean it up really quickly. So it's nuts that they went again after the technology industry, and now it's causing layoffs. And even Tencent has come out and said, guys, brace for a tough winter. That's what we're going to cover in this video. So once again, guys, smash that like button and subscribe if you're new. You're watching More Money. Let's get it. What's up, guys, and welcome back to the channel, where the goal here is to help at least 1,000 people achieve financial independence much sooner. And let's dive right into it. So you guys can see that over the last 5 days, it's just been brutal to own Alibaba. The shares are down 17%. And then looking out a little bit more, you can see from my historical share price returns on the tracker that the Patreons get access to, the 1 week return is actually negative 19.5%. So they're down even more than that 16% that I just showed you. Month over month return is down over 20%. And of course, you guys are all well aware, year over year, share price decline has been 63%. So once again, needless to say, it's been absolutely brutal. And it's crazy that we're seeing share price action like this on a company like Alibaba. I really think that 5-10 years from now, this is something that we'll really be looking back on and talking about, because I think it's like a once in a lifetime type of thing. But jumping right into it, you can see right here that there is more trouble for the Chinese tech companies because the government is now cracking down on live streaming. And what do I mean by that? Well, you can see here on the next slide that China has actually banned younger users from sending virtual gifts on live stream platforms. The government prohibited live stream apps from providing minors with facilities for online transfers or virtual gift purchase services. In addition, the government also ordered platforms to stop providing live stream feeds to minors after 10. Now, I might be in the minority here, but I really feel as though it should be the parents parenting the children. It shouldn't be the government parenting the children. So I very much might be out of step when I say that I should be imposing my cultural beliefs on someone else in a different nation. So I totally accept the fact that I may be out of line here, but it just seems weird that the government keeps doing things like this. And the problem here isn't what they're doing, it's the fact that what they're doing is unpredictable. So for example, a couple of weeks ago, they told the ride-hailing service companies to reduce their fees. Well, these companies are already not making money, and so now you're making them reduce fees even more to spur demand for drivers. I understand that, but it makes the market uninvestable because it's unpredictable. And it's almost like a seesawing effect, because you can see here, just a couple of weeks ago on April 29th, the shares of the technology companies actually surged because the Chinese authorities vowed to support the healthy growth of platform firms, and the Chinese Communist Party said that authorities will unveil specific measures to support the healthy and normal development of the platform economy, which of course includes the online technology companies. And what's interesting is that on this Yahoo Finance article, I actually found a couple of comments. There were the only 2 comments here, but what they said really resonated with me. So the first one is, stock investing is all about managing risk, and I agree with that. But there's no way to quantify risk where one dictator can instantly disable a company, market, or city with impunity. And he makes a lot of sense here, because you're seeing cities just get locked down. You're seeing whole businesses get wiped away. So like I said, I'm not against investing in China. In fact, I really love investing in China because you can get a lot more company for a lot less. However, it's completely different, and it's something that we all have to pay attention to when we invest in China. There is a huge predictability factor that's out the window, especially over the last year, as the government has made it very, very clear that we don't know what they're going to be thinking of next, and they could say one thing and do another, and we just have to expect it. And so the valuations for these names have to come way down to adjust for the fact that we just can't predict the future results. And the next commenter actually pointed that out. So you can see here, he said, investing in China is not really investing. It's about gambling on the mood and whims of a single man on any given day. Watch for their actions, not their words. And this is what I'm talking about, where they're saying one thing, but they're doing another, which makes them very, very difficult to predict, which makes it very difficult to invest in China. And so this is what I've been saying from all along for you guys, that Although Alibaba is my largest position, it's still a minority position when you look at the portfolio as a whole. And I really encourage everyone to consider diversification. Don't go all in on Alibaba. I know a lot of YouTubers have, and it hasn't gone past their CEO that the employees are scared. He actually came out at a company event a couple of days ago, and he just asked everyone to just relax despite the uncertainties surrounding the international situation and the pandemic. And Daniel Zhang's reasoning for this is that Alibaba is still an important contributor to society in China and continues to develop in a regulated manner. And actually, you can see here that I just put my investment thesis. And the point that I'm making is that the government, I think, is really going after the gaming and sort of technology industry next. That's very much in the wheelhouse of Tencent. And so because Alibaba is focusing so much on growing out grocery, that tells me that the government is really not going to be going after that lower margin type business. So Alibaba is probably more safe in an unpredictable regulatory environment, whereas Tencent is probably less safe, which is where I disagree with Manish Prabhai. I actually think Alibaba is the better opportunity in light of our unpredictable regulatory market regime. Now, Daniel Zhang went on to say that family members of Alibaba should please relax, despite the uncertainties in the international situation and the pandemic. The company overall is still developing as a whole. But here's the problem with what Daniel Zhang is saying. Daniel Zhang is a very wealthy man. However, the people that work with him, not so much. And you can see here that Alibaba Group and Tencent Holdings are preparing to cut tens of thousands of jobs this year in one of the biggest layoff rounds as the internet firms try and cope with China's sweeping regulatory crackdowns. Alibaba could ultimately axe more than 15% of its total workforce. And in the second last paragraph here, it looks like Tencent is also going to be looking to cut 10 to 15% of its headcount. And of course, you guys already know, these are the first major layoffs since Chinese regulators launched an unprecedented campaign a year and a half ago to rein in the internet giants. And of course, that regulatory crackdown, coupled with the slowing economy, which was pushed ahead by their zero COVID policies, has sharply reduced sales growth for most of these internet companies, smashed their share prices, and made new capital raising and business expansion much tougher in this economy. Now, of course, I must know, as reported by Reuters, Alibaba did not make this official. This information is coming from unnamed sources, and so it looks like Alibaba has already started to fire employees as of last month. They discussed job cuts with several business units and left it to them to make specific plans. And you can see from what I highlighted, some business units have moved very fast since then. Ali.me, which is their Uber and Uber Eats type platform, is looking to lay off up to 25% of its employees. And remember, I just put a note here. This is the segment where the government forced Ali.me to lower prices. So once again, you run into this issue where you are forcing these companies to lower prices. Well, they're no longer as profitable. They got to get rid of drivers. And it looks like the company's video streaming unit, Youku, is planning layoffs as well. Now, Youku actually sat in their development segment, so it wasn't profitable ever anyway. So the fact that they're just focusing on their core businesses makes a lot of sense here. And Tencent went even further. During an internal meeting at Tencent at the end of 2021, their chief executive officer, Pony Ma, told staff at the company that they should prepare for a winter. So in other words, winter is coming. Get ready. Didi is also planning to reduce its overall headcount by as much as 15% as its domestic business has been impacted by the lockdowns. If people can't move, well, they don't need Didi's services. Once again, none of these companies have made this information official. This is all coming from unnamed sources. So just be careful here. Some of this may turn out as being potentially untrue. And this article here pretty much sums up exactly my sentiments. This is all self-inflicted pain. An unprecedented campaign to rein in the internet giants in November 2020, starting with pulling Ant Group's IPO, which I kind of agreed with from a regulatory perspective. The fact that it's dragged out this long is a little bit concerning to me. And then the unpredictability came where they cracked further down on tech, finance, gaming, entertainment, and private education. It just made the market unpredictable. And you guys saw a lot of capital left China. Look, I actually doubled down on Alibaba just primarily based on the valuation. I don't really believe that the CCP is going to screw up the economy so much that Alibaba at $70 per share is overvalued. So I'm making a calculated bet here. However, it's still not a substantial part of my portfolio. You guys got to be careful of your concentration risk. But I don't want to leave it at a negative point. I do want to point out something very interesting. Alibaba just invested almost $400 million into their Southeast Asia arm, Lazada. Now, the problem that Lazada has is that they're competing against Sea Limited and Tencent out in Southeast Asia. So this is an uphill battle that they're facing. However, if you guys did see my 11-part or so series on that Alibaba Investor Day, one of those videos I went really deep into the Lazada business, and I showed you that even though Alibaba is second place in the Southeast Asian market, the market is growing incredibly fast. So there's room for two here. So I'm glad that they're continuing to diversify globally. They need it, especially in light of an unpredictable Chinese regulatory regime. Now, just looking at the options here, I generally don't talk about covered calls, but I do want to talk about it in this sense. If you were to buy the shares at $80 and then immediately just sell a covered call at $80, you'll collect a premium of $26. Well, that $26 represents an annualized yield of 20% with a net basis of $53 per share, or I guess $54 a share if you sold it at 26. But yeah, I actually think you can probably sell it at 27. So the question is Alibaba worth as low as $50 per share? I don't think so. If you guys go and find my video where I doubled down on Alibaba, I actually break down how much of the outstanding share price is just cash and cash equivalents on the balance sheet. It's nuts how cheap the company is right now. So I would actually consider a covered call opportunity. I don't think 2 years from now the shares are going to be trading at $80 per share, or actually 2 years from now they're going to be trading at $53 per share. But of course, I have to say this is never, ever investment advice on this channel. Now, looking at the cash secured puts, you can see here that the $80 cash secured put for January 19, 2024 with a premium of $20 per share, which is absolutely nuts, gives you a cost basis of $60 per share, but it also gives you a cash secured put yield of 15% annualized. So that's really exciting. Now, you guys might be wondering, how am I figuring out these annualized cash secured put yields? Well, the Patreons actually have access to a cash secured put analysis tool. You can see it right here, where for Alibaba, you can see that I threw in the put price, the put strike date, and the premium of $20, and it gave me the net purchase price, the put yield, which is a simple put yield, which is just 20 divided by 80. Never get fooled by that, because you have to annualize it, and because the number of days is greater than 365, it takes that into account, and it gives you an annualized put yield of 15%, and that's the one that you should be paying attention to. And of course, you can get access to my model, which includes all of the valuations, and includes the summary spreadsheet of all the companies and where they've gone in the last week, month, year, and the cash secured put analysis tool. But I do want to point out, the Patreon has a greater than 100% retention rate, as more people have decided to upgrade to the monthly call tier as opposed to downgrade by canceling. So the net retention rate of this Patreon is actually above 100%, which is very exciting. And what it really shows to me is that people are really finding value in this, especially as they sign on. So it's very exciting for me. But with that said, if you guys haven't seen my double down video on Alibaba, there's a lot of good information there, and you can get to that video right here.